As always, sheehan.patel@nbc.ca. Number is 905-849-3549. A little bit about us, Patel Wealth Management. It was started in 1981 by my father, Shik Patel, who was a stockbroker buying and selling securities for people for a commission. That life and that job is basically gone from where we started, and now we've really morphed into this full wealth management company, and we talk about finances and how to get you to a better spot. So a little bit about me. I started in the industry in 2014. I'm the associate investment advisor of the team, and my job is to take care of all the wealth management portion of our business and it's essentially relay it to all of the different specialists. So the best thing about Patel Wealth Management is we do work with a whole bunch of different people, and we do that so that we can provide our clients with the best possible advice. So I'm really, really pleased to announce that we have Carolyn Aversa, who is our mortgage specialist here at National Bank of Canada. She used to be the National Bank of Canada Hamilton branch manager, and she's been at the bank for, I don't know, 30 some odd years. I mean, she looks really young, so you guys will see that in a second. So Carolyn, why don't you introduce yourself?
Hi there. Hi everyone. I'm Carolyn. I am the mortgage specialist for the Hamilton Niagara area, and I've been doing this for many years. I've got a lot of experience behind me, and I'm here to help. Anything that questions you may have, I'd be happy to answer them.
Perfect. So today, everyone, we are going to talk about how to buy a house in Ontario from a financing perspective. I think it's super important that we all learn this, and this is something we do not learn in school. So this is a video that is kind of directed at anyone that doesn't own a house or people that are millennials that are just trying to buy their first house. So what we're going to do is I'm going to start off with the questions here. And Carolyn, why don't you give us the answer to this one? So before looking for a home, what are some of the first few things that people should do prior to actually looking for the home?
Well, before you start looking for a home, I mean, you got to have two key things. You've got to have some income, and you've got to have some savings to put towards your down payment. And you know, most clients, when you're ready to start looking for a home, you got a job, you're earning some income. You may or may not have some money put aside, but in order to move forward with a home purchase, you need to sit down with an expert and do a pre-approval. Find out what you qualify for based on the income that you have and the savings you have, or potentially how much you need to start putting aside to get to the goal house that you're looking for.
Yeah, totally. It's so important that you do that pre-approval. It gives you the gauge of how much you can afford, right? And then Absolutely. When you work with us alongside Carolyn, we actually plan for this, you know, the savings component. How do we get from that point A to point B and actually, use that savings to put into the down payment? So again, this is a two-way street here. The planner has to work with the financer, and we can get everything done. So another thing that is really, really important when it comes to buying a house or financing anything for that matter is the credit score. Tell us a little bit more about the credit score, Carolyn.
So the credit score is one of the tools that's used to judge, the amount of borrowing or lending that a bank will provide to a client. And it gauges your credit habits based on your payment history, whether you make your bill payments on time and how you use your credit. There is a score, and that score the banks will look at to determine whether they will lend you money or not. In Canada, there's two main credit providers or credit reporting providers, and it's Equifax and it's TransUnion. Now, the two of them both provide, they gather information from banks and provide it to everyone as far as being able to see what credit a client has. Equifax tends to be the main user for the banks. TransUnion is there, and they both provide a score based on your credit habits. The two scores are not apples to apples. The scoring system for each company is different. The main one that you hear talked about is the Beacon score. So the Beacon score is associated with Equifax. When it comes to credit worthiness, the score that banks typically look at is a Beacon score of 680 or more.
Oh wow, 680. So what's it go up to?
It can go, I see clients with scores in 800s, and those tend to be clients who have been on the credit bureau for a long period of time. Most clients, so that tends to be older clients who have had a credit bureau for 30 years, but someone who's younger, perhaps a first-time home buyer, most scores are in the low 700s is kind of a normal score to see.
Oh, wow. So I guess a lot of the people out there, when it comes to the credit score portion too, you don't realize that, when you get your first cell phone or that first credit card, that's helping to build the credit score. Is that correct, Carolyn?
Absolutely. Things that show on the credit bureau are your institutional debt, for example, credit cards, lines of credit, car leases, car loans, that type of thing. But you are correct, your cell provider usually does a credit inquiry on you when you're looking for a plan, and they do report your payment history on the credit bureau. So you've got to make sure that you're making your payments on their due dates and understanding how all that impacts your score.
Yeah, it's funny, in school, the teachers, unfortunately, it's not in the curriculum to teach this stuff, and that's why you need people like myself and Carolyn to kind of educate on how to use credit and how to build it. And of course, we'd both be more than happy to help anyone that needs that. But for the purposes of today's educational conversation, let's move on to the next question here. So you did touch on income. Why is it so important? And is income that kept under your mattress the same as income from a bank or another institution paying you a paycheck?
No, the reason why income is important is when a bank looks to see whether you qualify for debt, they want you to show that you've got the capability to pay it back. Even if you were lending money to someone yourself, you would want to make sure that that person could pay you back. So your income is the be all to end all, that and your credit score, as to how much of a mortgage you can qualify for. Now, not all income is the same. And it has to be verifiable. So that's why when you talk to a lender about borrowing money, they want you to bring in your paycheck, bring in your T4s. You've got to prove that you are making the income that you say you are. And there is a difference between guaranteed income, someone who has a salary that works, 37 and a half, 40 hours a week. That's very easy income to confirm and use, but there's a lot of people who have variable compensation. So variable compensation is anything that is not guaranteed. So when you have an element of your compensation that's variable, overtime, bonuses, commission, a bank will use that income, but because it's not guaranteed and it does fluctuate, the bank will look for you to have 2 years worth of history to show that it's consistent, and then they will use it in the credit application.
All right. Yeah, no. So I want to come back to that one point I kind of think I was alluding to. Say you're a server at a restaurant and you make some tips, or say you own your own construction company and you do a lot of cash deals. A lot of these people will come to us and be like, can we use this income? Like, I have this income coming in, I have the savings. Is that something you guys can take into consideration?
Basically, the income that we can take into consideration has to be on a tax return. So unfortunately, when you are in a cash situation, tips is a good example. it's nice not to report that from a tax perspective, but it will work against you when it comes to applying for credit, because a bank will typically look at the income that you declare on your credit bureau. Even self-employed individuals, you may write off, you'll have your gross business income and you'll have your expenses, and you'll come up with a net taxable number that you put on your tax return. That's what's looked at. So sometimes a self-employed individual will consciously report more income in a period of time that they're looking to purchase a home so that they can qualify for a higher amount of financing.
Awesome. Thanks for that answer. Again, that leads me to another question here. We've talked about the income side. Let's talk about the savings side. So, and I want you to touch on the first-time home buyer stuff and how much you need to put down. So why don't we work backwards? So say we're buying a $500,000 house here in Hamilton. How does that all work?
So in Canada, if we're not putting down 20% of the purchase price, we as borrowers have to have insurance on the mortgage. And the insurance is default insurance. So the default insurance is to protect the lender, but the borrower has to pay for it. So as a borrower, if you're putting less than 20% down, and you can purchase with as little as 5% down, 5% of the purchase price, but you have to get insurance. So there's two insurance carriers in Canada, CMHC, Canada Mortgage and Housing, and Genworth, GE. CMHC is a government insurance agency, whereas GE is private. They both do the same thing. They both cost the same amount of money. Lenders flip between the two for various reasons. CMHC is the main provider that lenders will use. The cost is added to the financing, so you don't have to pay for it out of your pocket, and it protects the lender. So if, as a borrower, we have a CMHC or a GE insured mortgage, and for whatever reason down the road through the mortgage, the borrower defaults and is not able to make payments on the mortgage, CMHC or GE pay off the bank mortgage, and then they take over managing the defaulted mortgage. So from the lender's perspective, it's not a risk for them, and CMHC and GE take over that risk when there is default. So as I said, the premium is added to the mortgage. The premium in Ontario, provincially, it's subject to provincial sales tax, or in Ontario anyways, it's the 8% tax. And the premiums can be, they can be a little large. So you can't forget to look at the PST in Ontario, for example. It's 8% of the premium. And that amount can sometimes be close to, $700-800, maybe up to $900, $1,000, and that's part of your closing costs, money that you have to come up with on closing. So it's important when you're dealing with your financial expert that you review all of those numbers as well.
I'm really glad that you brought up closing costs, and a lot of people think, I just need to save 5%. And I can buy a house. So 5% of $500,000 is 25 grand, and that's it. We can buy a house. Now you brought up the point of closing costs. Why don't you elaborate a little bit about closing costs and which ones are there?
So closing costs, the big one is land transfer tax. Just like, we buy a laptop, we buy any goods, we're subject to HST, which in Ontario is 13%. But if we had to pay 13% on the price of our houses, I don't think many of us would be buying a house. So, I'm not going to get into how much it is. It's a tiered tax. That's that fine. The higher the purchase price, the larger amount it is, but it is there. It's also, there's a first-time home buyer program whereby you get a rebate as a first-time buyer towards that tax. And it is a provincial tax. The rebate can be up to $2,000 depending on the purchase price of your home, and it is all handled by your lawyer. So the lawyer takes care of that for you. But for example, because it's a provincial tax, we're subject to it on the provincial level. But in case someone is listening and they're purchasing in Toronto, for example, that amount of land transfer tax payable to the province, if you're purchasing in Toronto, that same amount of tax is levied to the city. So if you're purchasing in Toronto, you're paying double the tax. So you pay it to the province and to the city. So you may want to look at purchasing outside of Toronto. But you know, it's something that even as a first-time buyer with the rebate, with the house prices that we're looking at now, it's something that, again, your mortgage specialist will show you what it is based on your purchase price. So you need to be aware of that number. There's also lawyers' costs, you know, and they can vary lawyer to lawyer. Usually when I'm sitting with a client, I always like to estimate a little more than a little less. I always estimate about $1,800 for the lawyer's cost. And that covers his fee and all of the disbursements that he has to make. So those are the two biggies. Now, again, if you're dealing with CMHC-GE, you've also got that PST that's on top of that as well. So you really need to know what those numbers look like, so that, because as you said, it's not just the down payment, it's the closing costs as well that you have to have available. And a lender will want to verify not only that you have the down payment readily available, but the closing costs as well. And just on a side note on that, a lender is very particular about the down payment. So you will be asked to provide 3 months or 90 days worth of history in your bank account to show that you've accumulated that money out of your own resources. So if you provide 3 months of history and you're putting down a $10,000 deposit, and last month there's a deposit of $5,000 into your account, the lender will ask you to explain where that came from. So the lender is looking for large deposits, and you will have to explain and prove where those came from.
Yeah, I have a question about gifting, and I know some of us are very fortunate, and we have, you know, parents that have quite a bit of money.
Yeah.
Can people use gifted money to buy a house? And how does the bank look at that?
Yeah, a traditional down payment is one that's granted by an immediate family member. Typically, a lender will have a document that has to be, it's really a declaration that needs to be completed by the parent, for example, the grandparent that's providing the gift. And it's also, it's signed and acknowledged by the borrowers as well. And basically, it must be a gift. So the document usually states that, you know, I'm providing this money to my son, daughter as a gift, and there's no terms of repayment. In addition to that, again, the parent has to provide 90 days worth of bank account history showing that that money they had on hand, and they're not borrowing as well.
All right, thank you for that. I think it's people should know that it is a viable option for people that sometimes just don't have the down payment but are still wanting to buy a house. Now, everyone, there is that question and answer button. I think it's right there. Click on it, ask your question, and I'll shoot it over to Carolyn. You get your question answered by a professional right away. Let's get I want to talk about, we're going to move a little bit over, and we're going to go back to that pre-approval process. And whatever's, you know, what's in the news a lot is the stress testing. Why don't we talk about the stress testing and, like, what is that, so people understand what this is before they go and get a pre-approval?
So the stress test was introduced in September of 2016 by the federal government. It's a rate, right now it's 4.79%. It has been higher. You know, I'm sure we all know that we're in a great rate environment right now. So rates have dropped. So that rate was higher. It's not the rate that you're going to pay on your mortgage. What the federal government is concerned that rates are really great right now, and eventually they will start going up. So they want to make sure that homeowners are able to still afford their homes as prices start to increase. So this rate of 4.79%, when a lender is calculating how much mortgage you qualify for, we use that interest rate to come up with the mortgage payment to see if you qualify for a certain level of financing. Again, it's not the rate you'll pay, but it's what we use to calculate the payments to see what you qualify for, so that, again, in the future, as rates start increasing, you've passed the stress test to make sure that even with increased rates, you can still afford your mortgage payment.
Yeah, 4.79 is a lot, right?
Yeah, it was higher.
It was higher, yeah.
Yeah, it was well above 5 back in January, so it has come down.
Yeah. Well, I mean, it's a good thing that the government put this in place. Just means that most people that are going to get a mortgage will be able to pay for it, right? You're seeing 5-year fixed rates, I think, under 2% at this point. So they're basically making it look like, when they're qualifying you, like if you can pay double, right, in the interest portion. Yeah. Okay, so it doesn't look like we have any questions coming in yet, so we'll just keep on rolling here. Now, I want to talk. I have 2 more questions for you. One's going to be about insured mortgages, and then the second one's going to be about RSPs and home buyers, the home buyers plan. So let's start with the CMHC insured mortgages. I know you alluded to it being called default insurance. Some people confuse this with mortgage insurance. They're 2 separate things, right? You can get mortgage insurance, and that will have, life insurance, disability, and critical illness, and that's on your mortgage. But what we're talking about is the default insurance, which means the risk is off the bank. So why don't you tell us a little bit about if it's actually a good thing or a bad thing to get an insured mortgage? Because I know that back when interest rates were 18%, an insured mortgage was not the best thing. Now we're at 2%. Maybe it makes more sense. So go ahead.
It's absolutely, I mean, if you can get 20% down, great, right? I mean, who doesn't want 20% down? But I don't know about you, but that's a lot of money. I don't know, a first-time home buyer property in Hamilton, for example, would be, I don't know, let's say $450, right? So 20% down would be $90,000. So the thing about CMHC, I mean, the downside is you have that premium that you have to pay, but the idea behind CMHC was it allows you to get into home ownership sooner. So if you can go in with 5% down, it allows you to buy that home now versus waiting. How long would it take you to save $90,000? And what will happen with rates and the price of houses in that length of time that you've got to save the $90,000. So that's the whole concept behind it, is it allows you to get into home ownership sooner. And, some of us are lucky enough to have parents to live with, and, you can set aside and save money, but others are renting. And, with today's interest rates and the rent levels that clients are paying right now, gosh, I've sat with a lot of clients, and the amount that you're paying in rent, you can own a home now, qualify for it. It's what you're missing is the down payment. So
I think a lot of people actually don't realize that.
Yeah.
They can pay for a mortgage payment with the amount of rent they're paying.
Yes. When my daughter bought a condo, her rent was greater than her purchasing a condo 5% down, including her property taxes and condo fees. So the amount of rents have increased as well. So many people, when you go through the pre-approval process, you'll be pleasantly surprised. If you're paying rent, your mortgage payment could be very similar.
Yeah, no, totally. Thank you for that. I think that was a really great answer there. We haven't got any questions. So I don't think we're gonna, answer any of those hypothetical questions, but I do want to say thank you so much. I think that this was great. I think a lot of people have probably got a lot of insight on how to buy a home in Ontario. And, if you have any questions at all, feel free to get a hold of me. Like, I mean, we do this on a daily basis for our younger clients, and even some of the clients that are not able to, have a house yet. But this is something that we deal with financing. We're with Carolyn, and we can work towards those goals to see if we get you in the house. So again, thank you, Carolyn.
My pleasure. And yet, Sheehan, like, this is what we love to do, especially first-time buyers. There's so much information that we can pass along to them, and it makes the experience so much better for the purchaser, because especially when it's your first home, it's very, very stressful. And to have someone there working with you to walk you through the entire process, explain it from top to bottom, it makes the experience fun. Like, it should be a very fun experience. So it makes all the difference in the world when you have the right partner working with you.
Totally agree. Buying your first home is always the hardest. So remember that. First one's the hardest, and remember to have all of your experts with you, because it will make the process a lot more enjoyable. And I agree with that statement 100 times over. So thank you again, and thank you everyone for tuning in. We will see you next time. We'll be back next week at 11:30 a.m. on a Wednesday. Ciao.
Thank you.